over and over and over again. Let's take a closer look at this specific day. Here's the high. It trades down below a short-term low here. So that's a shift in market structure. It rallies back up inside of this shaded area here. That's optimal trade entry. 79% retracement level, 62% retracement level there. The idea is that you're going to use the 62% retracement level as your hypothetical entry. Now, this is all hypothetical. You're not attempting to do these trades. All you're doing is building a study journal, which is back testing old data. So what this does, it helps condition you to see specific elements to these ideas and then watching it flesh out and build up as time goes on. Well, if you look at how this market goes from this high down to this low, shift in market structure, rallies back up, you go short right there. This is the first time the candle touches this price level. The stop goes just above this short-term high, so your stop loss is there. 10 pips, nothing less. Every single example, you're going to backlog and show in the examples a 10 pip minimum. That's the least of a stop loss you can use. That way, you're not trying to convince yourself that you can go in 2 pip stop losses, okay? Avoid all that stuff for right now. 10 pips is reasonable. If you're using a 15-minute time frame, that's reasonable. It doesn't mean that you won't get stopped out. It doesn't mean that it's going to work like that in the future all the time. It just means that as a rule-based idea, going in, studying, back testing data, you're looking at examples to frame out something that can build a respectable risk to reward model. Not that I have that as a dependence in my trades, because I don't look at it as I have to have this, I have to have that in terms of what I risk. You don't know what the market's going to give you. Just because you have your trade framed out with 10 to 1, you're risking $1 to make $10. You have no idea and no assurity that it's going to move $10 in your favor. No one knows that. There isn't a trader alive that's going to be able to tell you that's going to absolutely happen. But you have to have some kind of idea that you're going to submit to. Right here, we have 10 pips defined as our risk, and the market comes back up one more time. Note this, okay? So anywhere over here in your annotations, you want to record how much time it took when it started the trade here. How much time did it take before it started really moving in your favor? I like to see 1.5 of what I have risked before I would consider moving a stop. That was one of the original ideas I had from my trading is whatever I'm risking, it has to move 1.5 times that before I even move my stop. Now, if you have that rule-based idea, this return back into the general area where you got in would not stop you out. Many times traders would rush their stop down in here and it comes back, knocks them out, and then it moves in their favor because they're so afraid to take a loss. Do not be afraid to take a loss and submit yourself to the initial risk that you put on and leave that there until it at least moves 1.5 times what you've risked. What does that mean? Well, it has to move 15 pips in your favor before you move your stop loss in any degree. And at that point, I'm only moving it to half the initial risk. Once it does 2 times what I've opened up myself for initial risk, in other words, it's moved 20 pips in my favor, then I go to break even. And you want to have that annotated here. How much time does it take for you to be able to do that? And you log that, and you simply do this every single day. Old lows is what you'd be aiming for. So there's liquidity resting below that. It's sell stops. Using your fib, you have an extension of -1. So this is the target, but we're going to be trying to get deeper into this sell side liquidity pool. So this is our target. To get this, we're going to assume that the market needs to go at least a good 5 pips below that. Now, why 5 pips? Some brokers have really tight spreads. Wouldn't that get me out? No. As a rule-based idea, you want to anticipate a 5 pip run below where you think it might go. So frame all your trades that way. So that way, once the market does in fact trade to that point, 5 pips below it, no matter what broker you have about a 90% likelihood that they'll fill you. That's why I have that rule-based idea. And you can see the market does in fact trade down to that level. So 5 pips below this target, below this liquidity pool, that's where you would have it marked. Now, when you have it marked up like this, then you want to start adding all the annotations. But the main thing is knowing when that shift in market structure occurs. That's what sets up your pattern. And then once you have it all fleshed out with all the annotations, and it doesn't take long to do this. It literally only took me less than 10 minutes to mark this chart up just like this. And once it's all